Hi guys, thank you for joining me in another video. This video is going to be a little bit special today because I'm being joined by Anna, superwoman and fellow YouTube creator. She creates videos on financial freedom, so go check out her channel and I'll link it down below.
Hi guys, I'm Anna. I'm a chartered accountant and I make videos about personal finance, investing, getting out of debt and all that wonderful stuff. So if it's something you're interested in, do come and say hello on my channel, and thank you so much Fifi for inviting me to talk on your channel.
Thanks Anna. So firstly, we are going to talk about the UK housing market. I've had quite a few comments on what the hell is going on. We are in the midst of a recession, yet the UK property market has remained buoyant. So us Brits do fantasize a fair bit about property. Our home is our castle and all that jazz. So in this video, we'll try and break down some of the drivers for the property market here. Enjoy! So it's official. We are in a recession, and the deepest recession ever the UK has ever seen. So the latest stats released show that our output is still about 11.7% below where it should be. So output fell by about 6% aggregate in the 2 years following the Great Depression. I have a video about this which I'll link down below if you are interested, but there's a snazzy graph here which I'll pop somewhere so that you can see what I'm talking about. Now, while we are in a recession, the peculiarity of the economics of the lockdown is the government spending that has been here to keep the burners on for the economy ready to fire up, if you follow me. So in fact, the government this year is on track to borrow 115% of output. Our debt to GDP ratio overall will exceed 100%. So us personal finance folk know it's worrying stuff to have debt higher than our net worth. So the major driver for this has been the furlough scheme, where the UK government pays up to 80% of wages. However, the pandemic has also seen other quite innovative strategies. So that's Eat Out to Help Out, for instance, supporting restaurants by subsidising meals, bouncing back loans for business, or deferment, leniency from HMRC, stamp duty waivers on property purchases, the latter definitely helping with a surge in property inquiries. All these measures so far refer to fiscal policy, where the government uses taxes and spending policies to help navigate our economies. On the other side of the coin, we have quantitative easing, just a fancy word for banks printing more money, and falling interest rates, making debt and borrowing money as cheap as ever. So this does make large purchases attractive. In turn, this drives property buyers to the market, because they're attracted by both fiscal stimulus in the form of tax breaks such as stamp duty reductions, and optimism by being protected from the true state of the economy with government spending and low interest rates. So it's a good deal for property buyers at the moment. And finally, having the market locked down for so long during the worst of the pandemic has pent up demand and brought a sharp focus for letdowns of our current homes. So when buyers flock to the market, prices rise, and it's all about supply and demand. Now, property buyers right now, given the points discussed, are incentivized to buy right now. So if you are in the market and able to feel confident of covering your mortgage payments, then you'll be hitting the market. The group of buyers that make up 90% of property transactions are owner-occupiers, in that they buy the property to live in. So while there may be pockets of peculiarities in the market from investor activity, holistically, property prices are driven by owner-occupiers. So to sum up the backdrop of the housing market so far against the backdrop of our economy, the housing market has experienced a bit of a mini boom, and in that, land registry data itself shows that UK property prices are up 3% for the year, against a GDP fall of 5%. Many of the lenders hold their own data, all of which show a positive trend. Nationwide, who are a dominant UK lender, reported a 2% rise, and Halifax showed about a 5.2% increase in prices. And that's massive when you think about the delta change between the macroeconomic environment and house prices. That leaves the remaining 10% of property buyers who are investors, and they view property as a cash generating asset, and so yields, returns, etc. are very important in making good investment decisions. These do act as a dampener to demand, as when things get buoyant, deals make less economic sense. So likewise, when times are tough, there are deals to be had and astute investors step in.
So hopefully one of the things that has become clearer through this video is that all those things that are currently propping up the economy will wane away, and as they do, our economy will suffer hardship. As those support systems wane away, we will see a rise in unemployment, we will see businesses fail, and all of that will naturally have an impact on property prices. So how do you navigate the markets? Well, remember these few things. Property prices, like any market, are cyclical. They will go up for a while, then they'll drop, and then they'll continue to rise. History has shown that the property prices do follow the macro indicators. So as our economy does poorly, the house prices end up dropping. As we do well, house prices increase. It is something that you should be aware of, but you can't predict it. Secondly, like with any investment, it is time in the market that counts over timing the market. The property market in the UK has actually created many millionaires just by virtue of home ownership. If you already own a property or you're thinking about buying a property, just remember that you should be in it for the long term. In the UK, generally, homeowners tend to stick around for around 20 years. Now, I'm a little bit of an exception to that rule. I've actually got a shared ownership property that I thought I would be in long term, but my plans have changed and I will be selling probably after about 4 to 5 years of living here, which we'll see what happens. Initially, it would have made me a little bit of money, but now I'm not so sure because of everything that's happening. So you should really be sticking around for the long term to try and mitigate that risk. Thirdly, don't settle and be sold to. Make sure you negotiate the price. Make sure you look for good value and location. With shared ownership, it's slightly different. You have to purchase and sell at the fair market value, so there's no really negotiation there. However, with the majority of properties that are on sale, they will often be put on sale for more than the owner expects to get. When you are an owner-occupier and you are buying the property that you're currently renting, people tend to become emotional. But try to think like that 10% of people and really just keep your emotions out. That way, you're more likely to get a good deal and not just think, I would just pay this because I want to stay in this property. Now, while this is all well and good, you should make sure that you sit down and try to understand the difference between your rent and any interest that you would pay on a mortgage. These are both essentially money that's just thrown away. Because remember, the mortgage repayments that you pay are usually made up of not only the capital repayment, but also a hefty chunk of interest. And that tends to be front-ended. So if you're paying off £1,000 a month in your mortgage, in the first few years, out of that 1,000, it's likely you're going to have at least half of that, if not more, be pure interest repayments, which means that's not actually paying off your mortgage and it's not going towards your equity. The other thing that you need to think about on top of this rent versus interest comparison is building a deposit and making sure you can cover your mortgage repayments, especially if something goes wrong. So for example, if your income reduces by 20%, like we've seen in the furlough schemes, or if you go a few months without a job, anything like that, you need to factor in, because although this time round, there's been things put in place like mortgage holidays for 3 months, you never know what will happen, and you don't want to get into a situation where a few years down the line, after paying a hefty deposit and loads of money in mortgage repayments, you end up having your house repossessed because you didn't bear in mind any of these situations.
A big thank you to Panda Boss Anna for joining me in this video. Don't forget to go and check out her channel and hit that subscribe button. What do you guys think about the house market situation at the moment? Are you buying, selling, investing? Let me know down there in the comments below. But until next time, subscribe if you haven't already. Cheers guys, bye.